All right, let's dive right in. You see the word inflation in the headlines literally every single day. The news absolutely loves to turn it into this terrifying, panic-inducing event, screaming that prices are surging and you need to protect your money right this very second. But today, in this explainer, we're going to tune out all that noise. We are going to calmly look at what is actually happening to your money using real historical data and battle-tested strategies from some of the greatest investors in the world. So, let me ask you, do you feel like your cash is just losing its value right now? Honestly, it's a super common anxiety. But let's look at the actual numbers for a second. For context, looking at data around June 2026, inflation was sitting at 3.5%. And that was actually a cooling trend, not some massive, out-of-control spike. The takeaway here is that inflation is just a normal, ongoing part of how economies function. We just need to understand the mechanics of it totally fear-free so we can make smart decisions.
Here is our game plan for this explainer. 1. The silent wealth killer. 2. The cash is safe myth. 3. Inflation-beating assets. 4. The Warren Buffett strategy. And 5. The ultimate inflation hedge. Let's do this.
Section 1. The silent wealth killer.
Okay, so to really grasp what inflation does to your wallet, we have to talk about purchasing power. Simply put, this is just the amount of goods or services that a single dollar can buy you at any given moment. Think about it like this. If you take a crisp $20 bill and just leave it sitting perfectly still in a desk drawer for 10 years, it doesn't lose any dollars, right? You still have a $20 bill. But it completely loses its actual ability to buy the exact same amount of groceries. The money itself didn't shrink, but its real buying power did, simply because everything around it got more expensive.
Warren Buffett actually uses a brilliant and honestly delicious analogy for this: meatball subs. He says that investing is essentially giving up purchasing power right now, say the ability to buy 100 meatball subs today, in the hope that you'll have the purchasing power to buy 150 meatball subs in the future. That is your real return. You see, if you make a 20% gain on an investment on paper, but inflation is just running rampant, your real return might actually be zero. You might sell your investment, look at all your extra cash, and realize you can still only afford exactly 100 meatball subs. You literally had zero gain in actual purchasing power.
Moving on to Section 2, the cash is safe myth.
This leads us right into shattering a massive misconception people have during times of economic uncertainty. The common myth is that when things look shaky, keeping everything in cash is the safe choice. But the reality? Cash is actually one of the most predictably eroding assets during any period of positive inflation. It is mathematically guaranteed to lose some of its purchasing power every single year it just sits there. Safe and not losing value are not automatically the same thing. Sitting perfectly still with your money is essentially guaranteeing a loss in what that money can actually do for you.
Buffett takes this a step further, calling inflation a tax on people that have had faith in their currency. And when you combine the invisible tax of inflation with the actual ordinary income taxes on dividends or capital gains taxes when you sell, you get what he calls an investor's misery index. Even if a business does well, if this misery index exceeds your rate of return, your real capital shrinks, even though you consumed absolutely nothing. It just gets chewed up.
Section 3. Inflation-beating assets.
All right, so if sitting in cash is a guaranteed loss of buying power, what do we actually do? Let's pivot to the insider playbook for protecting your wealth. Tax and asset protection expert Toby Mathis uses a really specific 30-30-30-10 portfolio structure to combat this. Proper diversification isn't just buying two different mutual funds that hold the exact same tech stocks. Mathis suggests breaking it down like this: 30% in income-producing, dividend-paying stocks, specifically companies that historically increase their payouts every single year. Then 30% in real estate or real estate investment trusts, another 30% in a managed or mirrored portfolio where someone else is making the macro calls, and finally just 10% in highly liquid cash equivalents, which could include a small mix of silver, gold, or crypto. So 90% of the portfolio is focused entirely on assets that actively pay you. Let's zoom in on 3 specific assets from our sources that historically beat inflation. First up, cash flow positive real estate. If you buy a property and the rental income covers the mortgage, the taxes, insurance, and repairs, with profit left over, you win. Inflation naturally pushes up property values and rental rates. Second, recession-proof stocks. Think Walmart, Target, or Coca-Cola.
People might skip an expensive vacation, but they still need groceries and they aren't going to deprive themselves of basic comforts. Finally, TIPS or Treasury inflation-protected securities. These are brilliant because the actual principal amount you invest adjusts upward with inflation. If inflation goes up 4%, your principal goes up 4%, and you still earn your interest yield on top of that new, higher amount.
But hey, knowing what to buy is only half the battle, right? Equally important is knowing what to avoid. The experts warn us to avoid growth stocks like the plague during high inflationary cycles. Why? Because to combat inflation, central banks raise interest rates. Growth companies rely heavily on borrowing money to scale and expand. So, when interest rates jump, their debt becomes vastly more expensive to service, which just completely eats away at their future profitability.
Which brings us to Section 4, the Warren Buffett strategy.
So if we're dodging growth stocks and looking for established winners, how exactly do we pick them? Let's turn to Warren Buffett's master-level strategy. He argues that a favored business during inflation absolutely must possess two distinct characteristics. Number one, an ability to increase prices rather easily without fear of losing market share. This means they have a massive competitive advantage, or what he calls a moat. Number two, an ability to accommodate large dollar volume increases in business with only minor additional investment of capital. Basically, they need to be highly scalable without having to build massive, expensive new factories just to keep up.
To put that into perspective, let's compare a tech ecosystem to heavy industry. Imagine a production company that spent months and thousands of dollars training 50 employees on Adobe software. If Adobe suddenly raises their subscription by $10 a month, the company's just going to pay it. Finding a cheaper alternative would cost hundreds of dollars per employee in retraining and lost productivity. That is a moat. Adobe passes the inflation cost right on to the consumer safely. The exact same thing goes for Apple's locked-in ecosystem. Now, compare that to a shipbuilding company. They can't easily raise prices without losing bids to competitors. And if they want to increase volume to make up for shrinking margins, they have to invest millions to build an entirely new shipyard. Heavy capital businesses struggle. Asset-light, high-moat businesses win.
And finally, Section 5, the ultimate inflation hedge. We've covered real estate, dividend kings, and scalable moats, but we are now at the climax of this explainer. What is the single most empowering, low-risk investment out there? According to Warren Buffett, the absolute best protection against a rapidly declining currency is to improve your own earning power. Think about it. If you maximize your own talents, whether you become a better doctor, lawyer, programmer, or creator, they cannot tax your newly acquired skills while you're learning them, and they cannot take them away from you. If you become more useful and valuable in your profession, your personal income scales, permanently maintaining your purchasing power regardless of what the broader economy is doing.
Today, speaking of improving your earning power, you should probably subscribe to Growvi so you can actually become rich instead of just watching other people pretend to be rich on the internet. Seriously though, having the right information is the absolute best investment you can make. I want to leave you with this one final thought. We've looked at the data, we've busted the cash as safe myth, and we've mapped out the assets that actually survive this invisible tax. But knowing that the ultimate hedge is your own capability, what is the one skill you can invest in today to permanently increase your purchasing power? Think about it, go take some action, and I will catch you in the next explainer.